If you still think the stock market is just some billionaire playground where suits throw around money like Monopoly pieces, you've been scammed. The stock market is not just for rich old dudes, it's for anyone with Wi-Fi and $5. So in this video, I'm going to break it all down. What the market really is, how it works, and how you can start investing without needing to sell a kidney. Okay, so let's clear this up right now. What actually is the stock market? Think of it like this. The stock market is basically a giant online store. But instead of shopping for shoes or iPhones, you're shopping for tiny pieces of companies. Those tiny pieces, they're called stocks or shares. When you buy one, you literally own a slice of that company. You're not just a customer anymore. You're a part owner. So if you buy a share of Apple, you now own a teeny tiny part of Apple. You're a shareholder. If Apple does well, your share becomes more valuable. If they flop, well, your slice loses some flavor. But here's the wild part. There are thousands of companies out there. Tech giants, coffee chains, sneaker brands, even meme stocks. And they're all being bought and sold every single second on places called stock exchanges. Stock exchanges are like the marketplaces where all the trading happens. The two biggest in the US, the New York Stock Exchange and the NASDAQ. You've definitely heard of them, even if you didn't know what they did. And yeah, back in the day, trading was all shouting and chaos on the floor. But now, it's mostly all digital. If the stock market is just people buying pieces of companies, why do companies even want to sell pieces of themselves in the first place? And the answer is actually super relatable. They need money to grow. Let's break it down with a quick story. Imagine you start a small sneaker brand in your garage. Business is popping, people love your stuff, and orders are flying in. Now you want to scale up, open a store, launch a website, maybe hire a team. But all that takes cash, and you don't want to take out another loan or max out your credit card. So what do? You sell a small piece of your company to the public. That's called an initial public offering, or IPO for short. Basically, you're saying, hey world, if you believe in my brand, you can invest in it, and I'll give you a share of ownership in return. You raise millions, even billions if you're a big name, and now you've got the cash to take your business to the next level. Let's take a dive into a real-world case study. Look at Airbnb. Back in 2020, they went public. Why? Because they wanted to grow bigger, compete harder, and invest in the future of travel. They raised about $3.5 billion in one day. That's the power of selling shares, and just to be clear, when a company sells shares, they're not giving up control of the whole business. They're just sharing a percentage of ownership with the public in exchange for capital. Kind of like bringing on a bunch of mini investors. So yeah, companies sell shares not because they're desperate, but because it's one of the smartest ways to raise cash without going into debt. Now, you know what stocks are and why companies sell them. But how do you actually buy one? Like, where do you even go to grab a slice of Apple or Netflix? The answer? Stock exchanges. Think of them like digital marketplaces, kind of like Amazon, but for buying pieces of companies instead of ring lights and squishmallows. The two biggest exchanges in the US are the New York Stock Exchange and the NASDAQ. This is where all the action happens. Billions of dollars of stock flying back and forth every single day. Now, back in the day, you had to call up a stockbroker, say stuff like, buy me 50 shares of IBM, and then cross your fingers while some guy on the trading floor tried to make it happen. But today, it's all digital. You can literally download an investing app, like Robinhood, Public, Fidelity, or Webull, and if a ton of people want to buy a stock, the price goes up. If more people want to sell it, the price drops. It's like concert tickets. When Beyoncé announces a tour, everyone wants in. Prices shoot up. But if nobody cares, prices drop. The buying and selling happen constantly, like a giant auction running 24/7. Well, technically just during market hours, but you get the vibe. And the best part, you don't need to buy a whole share anymore. You can buy fractional shares, meaning if one Amazon stock costs $100, you could invest just $5 and still own a piece of it. All right, now let's talk about the part everyone's really here for. How do you actually make money from the stock market? So there are two main ways people make money from stocks. And the cool part is, neither of them requires you to sit there and day trade like a Wall Street wolf. Number one, capital gains. This one's simple. You buy low and sell high. Example, let's say you buy one share of Netflix at $200. A year later, it's worth $300. You sell it and boom, you made $100 profit. It's kind of like flipping sneakers or vintage clothes. You bought it for cheap, held onto it while it gained value, and then cashed out. But here's the thing. Most people don't get rich overnight. It's not some get in, get out game. A lot of smart investors hold onto their stocks for years, letting the value grow over time. That's what Warren Buffett does. Number 2, dividends. Now, this is low-key my favorite. Some companies pay you a small chunk of their profits just for owning their stock. That's called a dividend. So imagine this. You own stock in a company like Coca-Cola. Every few months they go, "Thanks for investing in us. Here's a little payout." That's free money just for holding. It's like getting a mini bonus just for staying loyal. You can reinvest those dividends and buy more shares, so your money keeps growing like a snowball rolling downhill. So yeah, you make money from the stock market either when prices go up and you sell, or by collecting little passive payments from companies that are killing it. The trick is play the long game, stay consistent, and let time do its thing. Also, fun fact, according to a recent survey by Charles Schwab, over half of Gen Z and millennials are already investing or planning to in the next year. And even better, some apps let you invest automatically. You can set it so every time you get paid, a little chunk goes into your investments. You don't even have to think about it. Like a money cheat code running in the background. So don't let anyone tell you need thousands to start. You just need a few dollars, a phone, and a mindset that says, "I'm building something." Because the truth is, waiting until you're rich to invest is like waiting until you're fit to go to the gym. It works the other way around. You invest to get rich, not because you already are. The stock market can be an intimidating place for people, and I don't blame them. Even after everything we've covered, I know there are still voices in your head, or maybe from your uncle at family dinner saying, "The stock market is risky. You have to be good at math." Isn't it just gambling, though? Let's break these down real quick. Myth number 1. It's too risky. Yes, there's risk, but literally everything has risk. Driving a car? Risky. Ordering sushi from a gas station? Very risky. The key with stocks is knowing what you're doing, playing the long game, and not putting all your eggs in one basket. That's called diversification, and we'll get into it later. Long term, the stock market has historically gone up, even with crashes and dips in between. The S&P 500 has averaged about 10% per year over decades. Myth number 2. You need to be a math genius. Nope, not even close. You don't need to calculate anything wild. Most investing platforms do the math for you. You just need basic logic and a bit of patience. If you can budget your weekend plans, you can understand investing. Myth number 3. It's just gambling. This one gets thrown around a lot. But here's the difference. Gambling is pure chance. You bet and hope you win. Investing is about buying into real businesses that make money, sell products, and grow over time. You can actually research a company. Look at earnings, read news, watch trends. So yeah, don't let these myths mess with your head. They've stopped way too many people from even starting. And if you ever feel overwhelmed, that's normal. Learning anything new takes a minute. But once you get the basics, you'll realize this whole thing is way less intimidating than it looks from the outside. Let me show you the real magic behind investing. It's not about timing the market. It's not about finding the next hot stock. It's about time in the market. That's where the long-term power of investing kicks in, and where you actually start building wealth. Here's a stat that'll blow your mind. If you started investing just $100 a month at age 20 and earned the historical average of 10% a year, you'd have over $200,000 by the time you're 50. And get this, you only put in $36,000 of your own money. The rest? That's growth. That's compound interest doing its thing. But what is compounding? Think of it like a snowball. You roll it down a hill, and it keeps picking up more snow and more speed. The longer it rolls, the bigger it gets. Same thing with your money. The earlier you start, the longer that snowball gets to roll, and the bigger your wealth grows without you having to work extra for it. Even if the market dips, crashes, or throws a tantrum now and then, it always recovers. That's why people like Warren Buffett say the best move is to just buy into a good index fund. By now, you're probably thinking, okay, this sounds great, But how do I actually start? Let's keep it super simple. Here's your 3-step game plan to start investing today, even if you've never done it before. Step 1. Pick a platform. This is where you'll do your investing. Apps like Robinhood, Fidelity, Public, or SoFi are beginner-friendly. It's as easy as downloading the app, signing up, linking your bank account, and boom, you're ready to go. Step 2. Choose what to invest in. If you're just starting out, look into index funds. These are like baskets of companies. One share of an index fund gives you tiny pieces of hundreds of top companies. A great starter one? VOO or VTI. They track the S&P 500, meaning you're investing in the top 500 companies in the US. It's low risk, super diversified, and way less stressful than picking individual stocks. Step 3. Start small and stay consistent. Don't wait until you've got $1,000. Start with what you have, even $5 or $10. Set up automatic investing so a little bit of money goes in each week or month. That habit alone is a game changer. It builds wealth in the background while you go live your life. And remember, don't stress about trying to be perfect. Before you go full Wall Street, let's talk about something way more important than hype. What not to do. These are the classic rookie mistakes that people make when they first start investing. And trust me, avoiding these can save you a ton of stress and money in the long run. Mistake number 1, panic selling. Picture this. The market dips, your account balance turns red, and your brain goes full meltdown mode. Sell everything. Don't. This is called panic selling, and it's like jumping out of a roller coaster halfway through the ride. Markets go up and down. It's normal. Historically, they've always recovered. Mistake number 2, trying to time the market. Timing the market means trying to guess when to buy low and sell high perfectly. Sounds smart, right? Yeah, and until you realize even professionals get it wrong a lot. And by professionals, I mean guys with 30 years up their sleeve and 5 master's degrees. Instead, try dollar cost averaging. That's just investing a little bit consistently over time, no matter what the market's doing. It smooths out the highs and lows and removes the pressure to be perfect. Mistake number 3, going all in on one stock. We get it, you love Tesla or Apple, but putting all your money into one single stock? That's risky business. Instead, spread it out. Mistake number 4, investing without a plan. Don't just throw money at random stocks hoping they blow up. Ask yourself, am I investing for the next 6 months or the next 6 years? Your goal determines your strategy. Short-term money might belong in savings. Long-term money? That's where investing shines. If you've made it this far, thank you. And as a token of my appreciation, here is a bonus tip. The best investors never stop learning. I love reading and listening to podcasts about finance. So if you want to keep going and get deeper into this money game, here are some resources that'll level you up fast. I will leave all the links in the description. The Intelligent Investor by Benjamin Graham, a timeless classic. Bit dense, but great for understanding value investing. Rich Dad, Poor Dad by Robert Kiyosaki, a super easy read that'll shift your whole mindset around money and assets. Classic Beginner's Finance book, I Will Teach You to Be Rich by Ramit Sethi. It talks about investing and how to manage your money like a pro. In terms of podcasts and videos, the Motley Fool podcast. Weekly breakdowns of market trends explained simply. Graham Stephan and Andre Geek on YouTube. They break down stocks, personal finance, and strategies without being boring. And of course, you can check out other informative finance videos on my channel. But if you're like me, a learn-by-doing type, start small, test things out, and let experience be your best teacher. If this video helped you out, drop a like, click the bell icon to stay notified with new uploads, and subscribe to show your support. Share it with a friend or family who would want to see this, and let me know in the comments. What's the first stock or fund you're thinking of buying?